We have all been there. You follow a stock lower, losing 5, 10% or more, but you hold out for that eventual rebound. I'm going to show you how to make one of the most difficult decisions in stock investing. How to know when it's time to cut your losses. How to know when it's time to sell those stocks for a loss. Now in this video, I'm not only going to give you 3 scenarios for when to sell stocks, but the strategies that you can use to turn that loss into a gain. We're talking when to sell stocks at a loss today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's Talk Money.
Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel. A special shout out to everyone in the nation. Thank you for spending a part of your day here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now this could be one of the most important videos you'll ever watch as an investor. And I know that's going to sound like an exaggeration, but I guarantee you, after watching this video, you will have the strategies, you will have the tools that you need to save yourself thousands in losses and get out of a stock before it's too late. Now I want to share a story with you, and anyone investing long enough has seen this firsthand. And this was originally a blog post from an investor and mistakes that cost him over $30,000 in just a few months. So Robert is from Kentucky, and if you know anything about the area, you know they love their coal up there in Appalachian country. So Robert was investing in coal stocks and really doing great, booking a 240% return in just a few years to 2011 on Alpha Natural Resources. But that's when the pain started. Coal prices plunged as competition from natural gas heated up. The coal companies had all put on mountains of debt in the good times, and it was absolutely destroying their stock prices in 2014. Now, Robert invested just over $10,000 in Peabody Energy, that was ticker BTU, and watched as the shares dropped like a rock from that first $16 a share to $11 a share, and then $7 and lower. But Robert loved his coal and was sure that it was going to rebound. Each time the shares took a big drop lower, he dollar cost averaged down, buying more shares so his average price would be lower. This is a huge mistake that a lot of investors fall into, chasing a stock lower, thinking that the lower average price, then you only need shares to rebound a little to recoup your losses. Now, pretty soon, Robert was sitting on nearly $30,000 in losses. Now, Peabody shares dropped to under $2 a share, and he didn't even care about making money anymore. He just wanted to get even, and was praying to just get even and make his money back. When the company eventually filed bankruptcy, Robert saw years of his savings wiped out. This is the #1 trap for investors, especially buy and hold investors that think of their time horizon as decades and that they can wait for an eventual rebound. People hate to sell at a loss. Even if that stock has dropped, it doesn't feel real because they still own the shares. Investors think if they just hold on, eventually that investment's going to rebound and they can get their money back out. But just like Robert saw, the market doesn't play by these rules. Even if you hold on to a losing stock long enough, you may never get your money back, and you could be missing out on potential returns in other investments. Just ask investors in Research in Motion, now called BlackBerry, or Citigroup investors that are up 360% since 2009, but still down 87% from before the 2008 crash. So I'm going to give you 3 scenarios, 3 reasons to sell a stock at a loss. Now this still isn't going to be an easy decision, but you will know when to make it. You'll be able to cut your losses in a stock, reinvest that money in a better name, and start earning those positive returns again. Now, not only will we cover those 3 reasons to sell a stock, I'm also going to show you why I hate stop loss orders. Now, these are a favorite strategy of investors, a strategy you might think is going to save you from losses, but I'm going to show you why I call these guaranteed loss orders. I'm using this video as a monthly update to our 2019 Dividend Challenge portfolio. I'll be highlighting 3 stocks in our portfolio, 3 stocks that haven't lived up to expectations, and using those 3 scenarios to decide whether to sell these investments. I'm putting this video in our 2019 Stock Market Challenge playlist, so if you haven't seen those earlier updates, those earlier videos, check those out. Along with some of the biggest channels here on YouTube, I created a portfolio with $1,000 in January, and I'm going to be tracking it all year long. To track my portfolio of dividend stocks, I'm investing $1,000 on M1 Finance, a no-fee platform that lets you pick your stocks and automatically invest any new deposits. Now, with all the changes to commission-free trading on most websites, a lot of you have asked if I still prefer M1 Finance for this, even against all those other choices. I still like it for that portfolio perspective that you get and the automated reinvesting across the entire portfolio. Basically, you set up your portfolio on M1 and automatically reinvest your dividends or deposits across all the investments and in the percentages you set up. It's a great long-term buy and hold investment strategy. Now, I'm going to leave a link to the playlist of videos below in the description. I'll also leave a list to the current portfolio of stocks in the description below, so make sure you check that out. Here we've got the portfolio as of midweek with a 20% return so far on the year, including those reinvested dividends. Now that's 4.6% better than the S&P 500, and it's even beating the Vanguard Dividend Appreciation Fund and its 18.5% return on the year. Now I'll scroll through the holdings real quick, but I want to get to those 3 signals to sell a stock at a loss and the examples that I'll use from the portfolio. Of the 13 holdings in the portfolio, 6 are beating the market with some real standouts, like this 118% return on shares of Hanes Brand, ticker HBI, and a 72% return on General Mills, ticker GIS. Now, 2 of these funds here, the Vanguard REIT ETF, ticker VNQ, and then the Vanguard Long-Term Bond ETF, ticker BLV, these have been critical in protecting the portfolio from some of those big down days in the market, and a lot of the reason that we're beating the market right now. Check out those previous videos in the series where I talk about why I added each of these stocks and what's really driving these returns. But now I want to get to those losers, those stock picks that haven't worked out, and how I decide whether to sell or just hold on. Our first scenario here of when to sell a stock at a loss, or at least when to consider selling, is when a company's specific mistakes have hit the shares rather than those industry-wide weakness. Now, Ford is a perfect example here. The 7% dividend yield is so persuasive, and shares trade for just 6.5 times on a PE basis. Despite that bargain basement price, Ford has been the worst performing stock in our portfolio with an 11.6% loss since adding it just a few months ago. But Ford's losses haven't been because of some management missteps or company-specific problems. Comparing shares here against the Global Auto Index, that's ticker CARZ, a fund of manufacturers and parts suppliers to the industry, you see that the shares of Ford have actually outperformed the industry over the last year. Going back even further, Ford's pain has been that industry weakness since 2015. And Ford manages making those tough decisions to guide the company through the environment, and I still believe that this can be a good investment when the overall industry turns positive. Now, if Ford's losses were completely of its own making, if the industry were doing just fine, yet shares of the company were falling on those management mistakes or internal problems, that's when you have to consider selling a stock at a loss and investing in something else. You know, a big part of successful investing is just finding those best-of-breed companies in each sector or each industry. We're talking about the leaders in each product category, the companies with great management and really a competitive advantage over their peers. If a company in your portfolio just isn't living up to that standard, it's time to cut the investment. Now, another situation where you might want to sell a stock even at a loss is when another investment just has a higher and more certain return. Now, understand you can't just be chasing stocks, buying and selling the newest hot tip you hear on CNBC. Understanding this rule, though, is so very important for your portfolio. Now, I understand every investor thinks their fallen stock is eventually going to get back to even. It's just part of that confidence that you build in your stock picks where you're so sure of something, you might even ignore the other evidence to the contrary. Now, there are 2 parts to understanding when you've just been plain wrong about a stock's fair value, though, and whether to put that money in a better investment. First, you have to analyze every stock on a current information basis. Now, this is a big one for losing stocks. It doesn't matter how much you've lost or where the price was a week before. You have to look at this stock as a new investment. So go back through your analysis, start from scratch, and look at the company as if you hadn't invested in it yet. Would you still buy that stock? What is the fair value based on the current information you have? And here you have to be impartial. Seek out the bull and the bear case on this and take everything into consideration. Now, even if you look at those shares and they still seem like a good investment, this next question you have to ask is how long is it going to take for that stock to get back to its fair value? How many years is that, and what's it look like as an annual return? And once you know all this, you can look back in the market to see if there's a similar stock, maybe a company in the same industry with those higher and more certain returns. So a good example here is the Alarian MLP fund, ticker AMLP. We've had this one in the portfolio since January. Now, this is a fund of 32 companies in the energy master limited partnership space, companies that own pipelines and storage facilities. It's got a massive 8.4% dividend yield, but has done nothing all year with just a 3% gain so far since January. Now, that combined 11% return isn't so bad, but this one definitely hasn't lived up to its expectations. Even though I like that yield and the midstream energy space, I have to question how long it's going to be before fundamentals turn this thing around. So last scenario here, before we get to that reason why I hate stop loss orders, why you absolutely need to avoid these. And this next scenario you need to watch for is just a major event against one of your stocks. Here we're talking about fundamental changes in the business, scandals, lawsuits, and just plain management issues in general. Now, these are going to include 5 reasons to sell a stock that I talked about in a prior video. Reasons to sell whether you've got a gain or a loss in the shares. Now, I'll link to that in the video description below, so make sure you check that one out as well. Now, this one goes back to that idea that you have to treat every investment as a new one when those big drops happen in the share price. When a scandal hits the company or management just decides it wants to make a major acquisition that's going to move the business into a different path, you have to reevaluate the shares and make sure that that buy thesis still holds. Now, Olin, ticker OLN, has been a big disappointment here, even more so considering that this stock was up 35% from where we bought it in late February, but has been nothing but bad news since. It's now sitting at an 8% loss after management missed earnings expectations for 2 quarters in a row. The company lowered guidance for earnings in July on a weak pricing environment and issues at a storage facility, but there really hasn't been one single catalyst for this drop. It's just been a slow bleed of investors bailing on the stock. Now, third quarter earnings are expected November 1st, so I'm waiting to get kind of a sense of how management plans to get it back on track. If they miss earnings for a third quarter in a row, it might be time to cut losses on this one. Now I want to get to one of the worst investing strategies you can use, that stop loss order, and just consider this something like a public service announcement. These things are that bad. First though, I want to get your feedback. We've seen my 3 reasons to sell a stock, but what are yours? What reasons have you used to cut ties with an investment and just put that money to work in something else? How do you make that decision? So scroll down and tell us in the comments below, what other reasons do you use to sell stocks? Now on to that public service announcement and why I absolutely hate stop loss orders. So a stop loss order is just a way to sell your stocks based on the price. You're telling your investing platform that you want to hold the shares unless the price drops to a certain point. If that happens, you want the platform to automatically sell the shares. Not that I would ever use this, but here's an example of a stop loss order on shares I own in Eldorado Gold. I've put a stop price here of $7.50 a share, which means if the price falls to that point, the platform is going to automatically sell my 10,000 shares. Now, on the surface, stop loss orders sound great. It's an automated order, so you don't have to be watching the price every day. If bad news hits that stock and the price starts falling, your shares are automatically sold at the earliest moment. Now, the idea is that you stop any further losses in the investment. Now, how a lot of investors use this is they put in stop loss orders to sell a stock if it falls below their buy price or a certain percentage below the current price. The problem here is, and this is why I call these guaranteed loss orders, is that you will never get that stop loss price. You might put in a price at which you want to sell the shares, but the market just doesn't work that way. When the market panics on a stock, so when bad news hits and the shares just start to tumble, that drop in stock price is immediate. Sure, the price might drift lower through the day or even rise above it, but that initial knee-jerk reaction that sends it down 10 or 15%, that's all at once. Now, what happens here isn't that all these stop loss orders get triggered on that stock all the way down. You've got the price before the news. The news hits and the market shifts what it's paying for those shares down that 15% immediately. So going back to our Eldorado Gold example, with shares now trading at about $7.70, if management came out and said they were abandoning the company's Greek assets, just selling off those assets at a loss, those shares would probably tumble 20% or more immediately. Let's say to maybe $6.22 a share. Now, I might have that stop loss order in at $7.50 a share, but the fact is, when those shares dropped, there was nobody there to take the other side of that order. Nobody wanted the shares at $7.50 each because this news just took it down to 6 and change instantly. But that stop loss order that I have is still going to trigger because the shares fell through that stop price. Instead of getting my $7.50 stop price though, I'm going to get the first price available, which is that $6.22 a share, where buyers are starting to offer more after the news. Now, besides the fact that you're never going to get that stop price that you set in a stop loss order, another problem with these is that initial reaction to the shares is almost always wrong. Have you ever seen a stock take a nosedive on some bad news, fall like 20% at the open, and then it drifts a little bit higher throughout the day? It still might close lower, but not nearly as much as that initial drop. Well, with a stop loss order, you get triggered at that market open and that knee-jerk price reaction to the news. Your shares sell at that initial drop in the price, and you miss out on that drift higher over the rest of the day. I know it sucks to see one of your stocks drop hard on some bad news, and it would be great to think that there's some magic strategy that's going to save you from losing money. The market just doesn't work like that, and stop loss orders are guaranteed losers. Click on the video to the right to see how I pick dividend stocks safe from a market crash. Don't forget to look in the video description below for that first video on how we set up our 2019 Dividend Challenge portfolio and how to get started with dividend stocks. Join the Let's Talk Money community by tapping that subscribe button.